it's some kind of melt-up. And a melt-up is a situation where, in general, the prices of tangible assets, that is, things that people want to own and where the supply cannot be increased as fast as fiat, that could include intangibles too, if you like, but the price of all those kinds of things has been on the rise as people are saying, where can I park my money? And
Welcome back to Metals and Miners. I'm your host, Gary Bohm, and today we're diving into the dynamic world of wealth management, global finance, and strategic investing. I'm thrilled to introduce Clive Thompson, retired managing director of wealth management in Geneva, Switzerland. With decades of experience steering high net worth portfolios through complex market landscapes, Clive's expertise in risk management, asset allocation, and global economic trends has earned him a distinguished reputation in the financial world. Known for his strategic foresight and nuanced understanding of international markets, Clive brings a wealth of knowledge to help investors navigate today's ever-evolving economic environment. Clive, it's an honor to have you back on Metals and Miners. Welcome to the show.
Well, thank you very much, Gary, and I have to thank you for that. That was probably the best introduction I've ever received. So many thanks.
Well deserved, Clive. Well deserved. All right, Clive, let's begin with debt and deficits. The government doesn't seem to really care much about cost savings at all. Doge was really a dud compared to expectations and all the talk and lead up. It seems like it was all lip service. With debt servicing costs having risen from about $350 billion a few years ago to now over $1 trillion and growing, we face a situation where we have to borrow more and more and more just to pay our debt servicing costs. Interest rates remain elevated in this cycle, putting even more pressure on the situation, as there is something like, 10 to 15 trillion in bonds that have to be rolled over in the next year or so. And if interest rates don't come down very soon, the debt servicing costs are going to explode much higher than they already are. Are you expecting rates to come down soon to ease the pain on those bonds needing refinance? And are you expecting even a debt crisis at some point because of the pressure that the debt servicing is putting on the budget? If so, how close are we to a crisis point?
Well, we're talking at the moment about the USA, but we mustn't forget that this problem is a global problem of Western democratic governments who are all running the same kind of problem economies where their debt is increasing. The reason we talk mostly about the USA is because it is the largest economy, and also because the figures are much more accessible than many other countries, which have parts of the numbers available, but not all the information available. So the situation we're seeing, we've just had a large rise in the US debt ceiling. I think it was 5 trillion or something like that. And that means that the debt ceiling, which has been frozen from January until just now, it means the Treasury will have to replenish its coffers, because what's been happening over the last 7 months is the Treasury has been running down its cash balances to pay the bills. They normally carry a cash balance of 800 billion or $1 trillion to basically have some money in hand for bills. So they're going to have to, that cash balance will be substantially gone, if not totally gone. And they've also been in this period of having the debt ceiling in place, they've been forced to carry out extraordinary measures, which basically mean they've stopped paying into government pension plans, and now they'll have to make those pension plans whole. So we can expect the government over the next few months to try and borrow, I would say at least $1 trillion, and they will probably have to borrow over the course of the next 12 months another $2 trillion on top of that to fund the ongoing budget deficits. Now, that's top of the head. That's about $3 trillion they're going to have to raise from the markets on top of the maturing debt, which will have to be rolled over. So the question is, will the market get indigestion when it's asked, can we borrow some money? And I think it will, because all the signs are that the natural buyers of government bonds they've got enough, and in some cases they're reducing. And I'm not talking about only foreign buyers like Japan or the UK or other countries around the world. I think I'm talking also about domestic buyers of government debt. There's a limit to how much every institution will want to hold of that, just from a pension fund, just purely from an asset allocation point of view. So, I think if the government debt is increasing at a faster pace in terms of how much is being issued than your other assets, your portfolios start to become unbalanced if you take your fair share of that. If a pension fund's fair share of it would be, let's say, for simplicity, 40%. They might get to 45, but at a certain point they're going to say, well, we don't really want it anymore. I think we're going to run into that danger where one by one the natural buyers of government debt have indigestion and won't buy it. So what then happens is the Federal Reserve will be invited or enticed or encouraged or ordered to step in and become the buyer of last resort. Now, the question you asked was about whether interest rates will be lowered, and I'll just touch on that before I come back a little bit to the Federal Reserve. The dot plot, or rather the expectation for the CME FedWatch, is that interest rates at the next Fed meeting at the end of July will have no change in interest rates. I think it's something like 97% no change is the expectation. And then the following meeting, which is in September, there's no August meeting, indicates there's a majority, slight majority, who think that the interest rates will be cut by 0.25%. So that's a small cut, but will that affect the long-term interest rates on government bonds and so forth? I doubt it very much. We've seen that we've had several cuts in the interest rates, short-term interest rates already, and what's happened? The rates on longer-dated bonds have gone up. And the reason they're going up is because nothing is being done to address the long-term debt, which is starting to spiral out of control. I mean, we're not spiraling out of control now, but we've certainly passed the point of no return. One of the biggest problems is that debt has been allowed to grow a lot in a period when interest rates have been effectively at zero, or as good as zero. So when the government was borrowing money over the last few decades, up until a year or so ago, they were borrowing at rates of less than 3%, 2%, 1% on their 5, 10, 20-year bonds, 30-year bonds. A lot of that debt will mature over the next decade and will have to be renewed. So we'll have low interest rate debt maturing, which will have to be renewed at a higher rate. So whilst the debt was growing very, very fast after the 2008 debt crisis, and again as a result of the COVID crisis, the problem on the interest rates, or on the interest burden, wasn't that bad, because interest rates had effectively fallen to zero for a decade or more, and the government was borrowing at low rates. But now that much of that debt they took out at those times is now maturing, and they're going to have to renew it. And they're going to have to renew it at rates. If you look at the 30-year bond, it's 4 point, what is it? It's getting on for 5%, and the 10 years is 4.4. So they're going to have to renew it at much higher rates than they were paying on the existing debt. Now, the problem with that is it means the interest rate burden is rising rapidly. So it'd be $1 trillion, I think, this year in interest, which is, and next year it's going to be more. And as this old debt matures, and as they have to borrow more to fund the current deficit, it does mean that the interest burden as a percentage of GDP, as a percentage of their tax take, which is coming into the Treasury, is going to just rise and rise and rise. And now, to draw a parallel, if you had a family with a credit card, and the credit card has no limit, which is effectively what we have with the government, you can imagine that as they spend money, the interest they're going to have to pay is going to get larger and larger as a percentage of their family income, until there comes a point where the interest overwhelms the total income of the family. And this is what's going to happen down the line in the United States and many other countries. So we come back to the Federal Reserve. So to stop that happening, the only way to stop that happening is for the Federal Reserve to step in and buy government bonds, driving up the price, lowering the interest rate on those government bonds so the government can borrow more cheaply. And what that means is the Federal Reserve, in doing so, has to raise the cash. And the way it raises the cash, the way it works, is to electronically print the money. That's the liability side of the balance sheet. So the Federal Reserve's got a balance sheet, liabilities and assets. The liability side of the Federal Reserve's balance sheet, broadly speaking, is the money it prints. And it used that money to buy the asset, the government bonds. So that's called quantitative easing, and we had that in the 2008 crisis. We had that in the COVID crisis, and then they went back into what's called quantitative tightening, where they shrink the balance sheet by trying to reduce their government bond holdings. They had mediocre success. Now, when I say mediocre success, it was less than mediocre. It was fractional success in reducing the balance sheet. It didn't come down much. It came down a little.
So how close do you think we are to that point?
Well, I think that we're going to see the Federal Reserve step in as buyer of the last resort, probably, definitely within 12 months, but I think quite possibly this year, probably October, September, something like that.
As the market begins to see that that is going to happen, not after it happens, but as they begin to see that it's going to happen, what does that mean for metals, commodities, et cetera?
Well, obviously that's an excellent question. First of all, what does it mean for the government bonds? Well, people are seeing this as a likely thing, and that is why government bond prices are not falling faster than they are at the moment, because they see that as a Fed put. But once it happens, once the government actually does it, it's going to be super bullish for all asset classes, because people are going to say the world is being flooded with money because the government can borrow freely without being constrained by these rising interest rates, because it won't be, because the Federal Reserve will be keeping the interest rates on bonds down due to their buying, and this money's flooding into the marketplace. So when the money comes into the marketplace, obviously in the first instance it's distributed very widely to the social security, pensions, the army, government employees and so forth. But the way all economies work is most people are living hand to mouth. And so that money, as it's distributed, the government's getting poorer, but so everyone's got some more money. But the people who get it usually don't hang on to it for very long. They spend it on Netflix subscriptions or the casino or whatever. And that money flows up the chain until it ends up in the hands of people who can manage their finances better. That would include people like you and I, but it also include people who are much richer than you are, the billionaires, multi-billionaires of this world. So as these people acquire this extra money, they're saying, what can I do with it? Well, they can't eat more pizzas. They can't drive their car any more than they're driving it. They can't take more holidays than they take. So where does that money go? It goes into tangible assets, savings. And they're not going to put it, if they've got their brains in gear, they're not going to put it into treasuries, which are being supported by the Federal Reserve and obviously on their last legs. So they're going to put it into things like property, equities, gold, silver, platinum, palladium, mining shares, bottles of whiskey, home extensions, Bitcoin, or basically anything that they believe will hold its value.
All right, well, let's talk about gold here for a second. So after the tariff talk started in earnest months ago, gold rose almost $500 very quickly. It briefly touched 3,500. It's come back. It's been hovering in that 32 to 3,400 range for several months now. During that time, though, a lot has happened, and many believe that gold ran too far too fast and it's going to come back down. And, you know, I heard estimates from the 2,700 to 2,900 range that gold was going to fall back to, but it hasn't. It has really held so strong, remarkably. Now, here we are a week or whatever after the big, beautiful bill is passed. It's going to guarantee extremely huge additional deficit spending. Some rate the bill at $4 trillion in additional deficit spending, some as high as $7 trillion I've seen over the next 10 years. The big question, why do you believe gold has held so strong over the last several months when a lot has been thrown at it? And do you expect to see a new up leg in gold beginning soon once this, we'll call it a consolidation period, is over?
There's a whole army of people who have realized the direction of travel of the government debt and how there is no handle on stopping it from growing at an ever-increasing rate. And that would include foreign governments, and it would include wealthy individuals who are well-advised. So a lot of these people and institutional investors are starting to say, as I've got more and more money, where do I park it? Gold is an obvious place to park it. I mean, it's not the only place. We're also seeing, record highs on the stock market at the moment. A few months ago, we had this huge drawdown. Everyone said, "Oh, it's the bear market starting." And we got down. I think we got down about 19%. So
we actually have, highs in the stock market, Bitcoin, real estate. I mean, we actually have highs in just about every asset class.
Yeah, copper. I mean, oil. Maybe not oil at the moment.
No,
but but it wouldn't surprise me. I did a quick run through all the major commodities and assets I could think of, and there was, with one or two exceptions, they were all on a sort of 5-year basis, looking as high as at the top of the chart. What I think we're now in a period of which I would describe for the last 5 years, it's some kind of melt up. And a melt up is a situation where, in general, the prices of tangible assets, that is, things that people want to own and where the supply cannot be increased as fast as fiat, that could include intangibles too, if you like, but the price of all those kinds of things has been on the rise as people are saying, where can I park my money? And of course, where they park their money, it flows. One day it's flowing into equities, the next day it's gold, the next day it's Bitcoin, the next day it's property, and it goes around in circles. And you have these phases where things take off and rush. We've had this rush on silver, we've had this rush on platinum in the last few weeks, where those, for example, silver, which was trading at $32, $33, has rocketed up to $38 in almost no time. That's what's that? That's $6. That's nearly 20% in a week or two, a few weeks. And gold has done nothing in that period. But then before that, it was gold, and silver was doing nothing. And then, of course, we've just the last few days we've seen this 20% rise in the Bitcoin price. So the money sort of jumps on the latest bandwagon, and then it leaps onto the next one, then it leaps on the next one, and then it comes back to the first one.
But the assets, once the money's leaving an asset, the asset's not dropping too far. It drops a little bit, but it's holding remarkably strong. So I think that's the takeaway, on that topic, is that each one of these assets is holding remarkably strong when the money leaves and goes to the next asset, because it's looking for safety from...
Yeah. Because there's simply an army of people who missed the boat on the way up. And they're sitting there saying, it's back to the price at which I should have bought it.
Right.
And then they dive. And then, of course, it takes off again, and then we have a new upwave.
Well, let's focus on silver a little bit here. Clive, you mentioned 38. I actually, last week, I think I saw it touch like a little bit slightly higher than 39. Either way, it was the highest since 2011. But the gold to silver ratio, it's still really high. It's around 86 or so. It's very historically high. The aggregate ratio over the last 50 plus years, it's been between 50 and 60. That would put the price of silver around $60. So I've got 4 questions on silver. Let's start with the first one. Do you expect to see silver to continue to stair step higher as gold is stair stepping higher?
Yes, I think not on a daily basis or a weekly basis, but I think over the longer run, silver is going to be the better performer. And the reason is because, first of all, there's 2 reasons really. First of all, unlike gold, there's a supply and demand dynamic in silver. And we know, based on the information from the Silver Institute, that since the last 3 or 4 years, the demand for silver has been rising rapidly, mainly due to increasing electronics usage, whereas the mine supply of silver has been dropping for the last decade and not forecast to increase, probably because a lot of silver is produced as a byproduct of other things like copper mining, although we've just seen that copper has just hit an all-time record. So maybe there will be a bit more silver coming out of the ground. So there's there's the supply and demand dynamic. But the other thing to say is, for a lot of people, silver is the poor man's gold. Some might say it's platinum today, but I think silver's really the poor man's gold. So when people feel that they need to park money somewhere, when it's getting to a wider audience, the rich people have heard first and they're buying gold, but the people at the next layer down aren't quite as rich, and they're probably saying, "Oh well, I'll buy myself a few silver coins." I mean, I'm seeing this year more and more of my friends announce to me, they know I collect silver coins, they know I collect gold coins, but they come to me and announce proudly, "Oh, I bought this coin." They show me one silver coin. I'm thinking, it's not really moving the needle for you, because when I'm buying them, I'm buying 20 or 30 or 50 of them at a time in silver. People are starting to dip their toe in and buy gold, silver and gold. And then when they come to me and show me a gold coin, they've got these little quarter ounce or 1/10 of an ounce coins that they bought. Again, it's a start. It's a start. But I think we've got a class of people coming into the market now as buyers, which wasn't there before, and they're going to buy silver.
I agree with that. And do you expect to see the gold to silver ratio remain elevated as it has in the upper 80s and maybe even into the 90s as it has been? Or do you expect that 50-year aggregate to play again and it to revert to the mean sometime in the foreseeable future?
Well, I think the direction of travel is for silver to perform better than gold over the medium term. That doesn't mean on a week by week or month by month basis, but I think we're looking forward for the next couple of years, most likely. But of course, we might get, we don't know if we'll get this, but we might get a blow-off top. What's a blow-off top is when the price of the asset, silver in this case, rises very, very rapidly, far more rapidly than one would expect. And that draws attention to all the silver hoarders who then say, I'll take advantage of this, and that will put a cap on the rise when it happens, right, and bring out sellers. So this is a common feature of a rapidly rise. Assets rise rapidly and people jump on board, I'll capture the gap rise. But at some point, those people are chasing the asset, run out. And that's
typically that typically happens at the end of a precious metals bull run, what you're describing. And normally you see sentiment through the roof, people talking about gold and silver everywhere you go, your Uber driver, the parties you go to, and that just doesn't seem to be the case yet. So, but it does sound like you do believe at some point in this cycle, whether it's soon or later, that silver will have that parabolic move. That feature of a precious metals bull market will be intact this time around as well.
Yeah, and if we go very, very rapidly to, say, $150, which I cannot exclude, then you have this wave of sellers come out and they might come back to 50, but we're still going to be ending up at a much higher level than today's level.
Well, and that's something I was going to ask you too. So we have this much higher starting point than previous silver bull runs, right? And so with this starting point much higher than it has, if we do have that parabolic move at the end, what price range do you think that could even look like? 150 higher?
In a parabolic move, there's no real top in a world where you've got money being printed. It's what captures the public's imagination. Certainly, silver could go above $150. I mean, if you just simply take the previous all-time high of $50 which was I think they had that in something like 2011, something like that, a decade ago. If you just adjust that for inflation, it's got to be at least double that. So we're already above 100. But in bull runs, there's really no top that people can describe. Bull runs can just keep going and going until suddenly there's no more buyers left.
That's absolutely true. Okay, so, and we've seen that in every asset class. All right, well, let's discuss platinum. What are you expecting to see in platinum as this precious metals bull run continues to unfold? You had mentioned that over the last 17 years, the price of platinum has moved from double the price of gold to less than half the price of gold. Are you expecting a rapid price appreciation coming up so that platinum relative to gold would be somewhere where it was 17 years ago? Or are you expecting price appreciation in platinum to move slower than gold?
Well, I remember as a child, my father was always very proud of his platinum wedding ring, which he would show off to all his friends, because platinum at the time was worth a lot more than gold, maybe double the price of gold. So right now, platinum is about 1,000, just below $1,400, whereas gold is about $3,300. Uh, Platinum is less than half the price of gold, having come from double the price of gold. So there's a long way for platinum to go to catch up. And most of the world's platinum is mined in South Africa, with a little bit more being mined in Russia. Both countries which are not quite as stable as the rest of the world. I know South Africa in particular is in the platinum mining industry is plagued by electricity cuts. That's one of the biggest problems for the platinum mines in South Africa. So if everything carries on as normal, it will still come out. But according to the estimates, there will be, and there is, a shortage of platinum in terms of the mined platinum being less than the consumed platinum. European regulations from 2026 will require a greater use of platinum in the car manufacturing industry. That's not my information. That's information I've read elsewhere. So the demand for platinum is set to rise. The mine production may not increase, but it's already in deficit. And according to the forecast that I've seen, the above ground platinum supplies are set to they're almost nothing. So they're set to go down to less than 1 year's supply within a year. So 2 years forward, there won't be any above ground supply of platinum really. So the price of platinum to drive platinum out and to make it available to car manufacturers, it has to go higher.
Okay. All right. Well, I have an AI question for you that's tied to commodities here. Okay, Clive. So with AI rapidly progressing and potentially displacing jobs, and quite frankly, in the near future, I'm hearing maybe in the next 2 to 3 years, robotics will be able to also replace significant amounts of jobs. The lingering question is if it's going to cause a deflationary wave by reducing manufacturing costs so dramatically, but also while simultaneously increasing commodity demand because of AI, robotics, and manufacturing and the like. So without a significant investment in commodities to this point, it should have happened 10 years ago. But without this significant investment in commodities, how can this dynamic be navigated in reality? Meaning, won't supply deficits occur all over the place and prices spike all over the place if we have this massive AI and robotics explosion, yet a lack of investment into the underlying commodities?
Well, first of all, productivity is set to continue to increase thanks to automation, AI, and obviously AI is the big word now. Automation, robotics is an ongoing process we've seen for decades. But AI brings a whole new dimension to this because it means that the robotics side of it, the automation side of it, can be developed many times faster than it has been in the past. Around the world, we're going to see the ability to increase production or actual production increasing rapidly. And that, of course, does consume more commodities of all kinds. Can they get the commodities out of the ground faster? Well, AI is helping with that too. If you take as an example, take RTZ in Australia, they have huge parts of their operations run by AI or robotics. I think they call it AI, although it might be robotics already. With mining machines run now. One guy sitting in a room somewhere controlling multiple mining machines, hundreds and hundreds of miles of railways.
I don't mean to interrupt, but silver supply has been in deficit for 5 years, and the projections for silver moving forward, despite AI being present, no massive increase in supply. So, and we see that in copper, we see that in gold, we see that in some other areas too. Anyway, continue.
Yeah, so, I mean, at the end of the day, there will be an impact on mining because AI will help improve production of everything. It will be possible to do more mining without more staff or without more workers. But will that fill the gap of the extra demand from all this extra manufacturing? I don't think so. So I think we will see rising commodity prices as the demand, I suppose, is it, I don't know if we call it demand increasing or rather supply push, because the manufacturers will be pushing the goods out, whatever they're making. We all live in bigger houses, drive better cars, have faster computers. I don't know. But the other side of the coin is what's going to happen to all the people who are losing their jobs? Realistically speaking, already today, almost 50% of everybody's job who sits at a desk can be done by AI immediately. The trouble with the other 50% is it requires prompt engineers and programmers to develop that other 50% to take the whole of the job. But that will happen in the next 3 years. I mean, it's a race. And obviously there's companies who say we won't let it happen because we care for our people. But if they don't do it, their competitors will. So it's going to happen. AI is coming with a vengeance. A lot of people will lose their jobs in the next few years. We're already seeing clear-cut signs that many institutions are not taking on the number of graduates this year that they took on in previous years, because they're saying, what can a graduate do? Well, it cost us money, but the guy who's the graduate's boss is now 10 times as productive. He doesn't need these graduates working for him. He doesn't need to say to the graduate, go out and research this company. He says to his AI tool, research this company, and he gets the answer in 10 minutes instead of a week.
Yeah.
And, if you think about it,
go ahead.
Sorry, if you think about it, the AI doesn't take holidays. It doesn't have kids. It doesn't have sick days. It doesn't ask for pay rises. It doesn't stand by the coffee machine chatting with its work colleagues. It doesn't piss off the lady, the cleaning lady, or the girl at the next desk. It doesn't need a cubicle. It doesn't need a chair. It doesn't need a desk.
It keeps getting better. It keeps getting better and more efficient.
And whilst it might make mistakes, it makes less mistakes than the humans do. So the case for moving AI into virtually every desk job is very compelling.
Yeah, I agree. And, I've had guests on the show who believe that, we're headed for a massive unemployment event because of AI and robotics. And I've had some that believe that it's going to catalyze some, old jobs, but create so many new ones that there'll be a net positive gain. We'll see on that side. My interest lies right now on the underlying commodities because of the demand and the explosion that's coming. And I think it's important for us to be focusing on those commodities. But this has been an incredible discussion. And I just want to welcome everyone who's tuning in to this fantastic interview with Clive Thompson. Before we wrap up here with our final set of questions for Clive, I just want to direct everyone who's interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report. So go check everything out that's over there at the Substack. Thanks again for watching the interview. Also, if you've been enjoying the conversation as much as I have with Clive, please let him know, hit the like and subscribe button, and leave a comment below the video. All right, Clive, let's just finish off our discussion with our asset ranking lightning round. I'm just going to ask you to rank a few assets as a buy or a sell by giving it a score of 1 to 100. 100 is an extreme buy, 1 is an extreme sell. Then just give 1, maybe 2 sentences for your take. And just understand we're going to flow through these as quickly as we possibly can. All right. So we'll call the time period the next 6 to 12 months from today. So on a scale of 1 to 100, is gold a buy or a sell right now, and why?
Well, I think gold is well supported, definitely a buy. I think I'm going to put it, I have a forecast expected financial return of 8% above inflation. whatever inflation will be, and I think inflation will rise. So I'd classify that as about 70 or 80.
Okay. 1 to 100 gold miners.
I think that the case is more compelling because they are way below the level they were in 2011. According to my calculations, the price-earnings ratios of many of these gold miners is going to be below 10 next year. So we'll have low price-earnings ratios with high growth because the earnings will have risen, the dividends will have risen, and that should be self-correcting in terms of the price-earnings ratio rising, i.e. the share price rising. So I think gold miners will perform very well, so I'm going to give it a 90.
Okay, silver, physical silver.
I think that's sort of an 85. Silver physical, for the reasons we discussed, will rise.
Okay, silver miners.
Again, I'll put that at a 95.
Okay. Copper.
More prone to industrial demand, which is rising because of the need for electrification related to everything which is going on in the world. It's an all-time high. I think it continues to creep higher, so I'll put it at a 60.
Okay. Uranium, the metal.
Well, I think that's a hard one to call. I don't really follow uranium, but it's quite clear that the world has to have a lot more nuclear power. I'll give it a 50. Given that I think if I'm not mistaken, I haven't followed it. I'm assuming it's risen a lot. Am I right? It's risen.
Yeah, it's hovering in the low 70s right now. It's up, maybe $12 or so in the last 3 months. So
I don't think it catches much investor attention. And secondly, the uranium miners are either not making money or overpriced. So I'm not really into that.
Okay. All right. Oil.
It seems there's almost unlimited supplies of oil. The Saudis are being very cooperative in producing oil at the moment. That we're not in any sort of oil crisis, but of course it could come about by some sort of problem in the Straits of Gaza. But you have to assume the best and assume it won't happen. So I'm going to give that a 40. Not very positive.
The NASDAQ.
It's very overpriced. But that has never meant that it can't continue rising. As we saw in 1994, it can keep going and going and going and going for 7 years and becoming more and more extreme. But with the amount of money coming into the world, I think you've got to be a bull of NASDAQ, but it's not, those Mag 7 is not where I'm going to put my money. So I'm going to give it a 65.
Okay. S&P 500.
Well, slightly better pricing, but it's prone to the same problems of those Mag 7 stocks. So I'll put that at a 65 as well. I think NASDAQ and S&P will be neck and neck.
Okay. Short-term treasuries.
I think you're going to lose money, both even after the interest rates. When I say lose money, I would lose money relative to the underlying inflation rate, because I think the price of treasuries will not. I mean, even the short end will the prices will come off a little as the government borrowing needs increase. So I'll give it a sort of 40.
Okay, long-term treasuries.
Well, that's obviously much more dangerous because the prices should come off more rapidly. So I'll say a 0.
Okay. On a scale of 1 to 10, each representing a percentage, where do you see inflation ending the year?
Official inflation, probably about where we are now, sort of 3%, I think. Okay. But the unofficial inflation rate is the increase in the liabilities of the government, which will be about 7% or 8% higher.
Okay. 1 to 10, 10 being the highest. Are we headed into a recession by the end of 2025?
Countless recessions have been called and never happened. Statistically, even though it looks like we're heading into a recession, most recessions which are supposed to happen don't happen. So I'll say no.
Okay, so that would be a 0?
No, I mean it's I would say it's about 40% probability.
Okay, so a 4 out of 10. All right, and lastly, the recommended portfolio allocation, it used to be 60-40, 60% stocks, 40% bonds. That seems to be changing very radically right now. What percentage of the portfolio do you recommend for precious metals and precious metals equities? And which bucket or buckets are you pulling that from?
So I publish on LinkedIn about once a year an asset allocation table. It really hasn't changed very much at all. The last actual publication was in September 2023. I haven't done one since then. On that occasion, I increased my allocation to silver from 6% to I increased my allocation of gold from 6% to 9%, and I left my allocation of silver at 6%. So between the two of them, that's 15%. That's probably below the figure you want to hear, but of course, if you'd bought the 15% then, it would already be 20+% because of the price rise. You probably want to hear a much higher number, but
No.
obviously there's many other asset classes I like to invest in.
I want to hear what you recommend. So I'm happy to hear your number. Does that 15% include the miners, or is that all physical?
Yes, it includes the miners. The way I described it is silver and other precious metals, including silver held by custodians and banks and ETFs and silver mining shares and silver custody bars, bullion coins, collectible coins, old used coins, with an allocation to platinum as well. And that more or less the same type of thing for gold. So that's kind of how I describe it. So in other words, you definitely want to have some gold and some silver where you can get your hands on it quickly and easily.
Right.
But there's a limit to how much you can self-custody. So beyond that, you have no choice but to use other things like silver miners or ETFs.
Understood. Okay, great. All right, Clive, would you please share a key takeaway that you want viewers to keep in mind about either today's economic, market, or monetary situation, and then just let everyone know where they could find you on LinkedIn to learn more about your work?
So, first of all, one of the things I've done recently is I've started my own YouTube channel, and it's almost totally focused on the stock market. So basically for beginners in the stock market and experienced people. I've been investing money for 50 odd years, and I had some exposure to it before that. And I have the courage to publish every year on LinkedIn an investment portfolio. In 2024, it was 55 stocks. In 2025, it was 40 stocks. The 55 stocks collectively are up over 50% now. That was from 2024 and half of 2025. The 2025 stocks are up over 21%. I share that portfolio. I publish on LinkedIn. I share it with everybody who wants it up in the form of a spreadsheet. So without the slightest doubt, it's smashing all the benchmarks. So I have a lot of confidence in that. So people who want to find me can come on LinkedIn and write to me there. That's the way to find me. My YouTube channel is focused on stock picking and how to get involved in the stock market. I find that many people don't understand how to do that. Of course, I'm talking about gold and silver as well, but I'm talking about everything related to stocks. By the way, I just last week won the TradingView June competition for the best trader. Well, it wasn't the best trader. I came in out of 58,000 players, I came in the top 1% with a profit for the month of 48%.
Well done.
I would have won 3 prizes, but you're only allowed to win 1 prize. So the prize they actually gave me was the prize. I got second place in the traders who had more than 10 trades without making any losses. So I had 17 trades. I didn't have a single loss in the month.
That's awesome.
So the winner had $48,000 of profit, something like that. I had $48,200 of profit, again with no losses. So I took the second place in that one, and I would have taken also the prize for the biggest single profit and the one of the top. Being in the top 0.5% of players in that game. So it's not that I want to say that I'll make a lot of money always, because I always say you can lose money, and I don't have that confidence to say I'll always make a lot of money. But I think I tend to make less mistakes than I made when I was 20 years old.
We appreciate you sharing the way you share. Did you give your LinkedIn address, by the way?
Yes, just Clive Thompson. And if you look for me on YouTube, it's Clive Thompson 2, and you can see my videos on YouTube. Sometimes I have my little son, who's 8 years old, participate in the videos, and he asks clever questions like, what's a bull market or what's a bear market, those sort of questions, and it's quite fun.
Okay, wonderful. Well, I'll have all that information up for everybody to click through. If you have not followed Clive or seen any of his work, you're really missing out. You really should. He is such a straight shooter. He shares real information, and he's so freely giving of the information since he's retired. So, on behalf of everybody, Clive, thank you for all you're doing for the investment community. And thank you for coming on to Metals and Miners and for being so generous with your time, analysis, and ideas. I always love catching up with you and spending the time that we have. I look forward to having you back on sometime soon. Thanks again for being here. And everybody else, thank you for watching.
Thanks very much. Thumbs up, everybody.
This has been an incredible discussion, and I just want to welcome everyone who's tuning in to this fantastic interview with Clive Thompson. Before we wrap up here with our final set of questions for Clive, I just want to direct everyone who's interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report.